WA3 listens live. I'm Michael Vanover, joined now by a very familiar face to the program, Marcus Warren with Warren Wealth Management and Tax Planning. And Marcus, you're here each and every Wednesday. We appreciate you being here with us today. You've got some great things we're going to cover today. One of the things that we'll get to here in a second, but before we do that, is if you could give us a little bit of background on Warren Wealth Management and Tax Planning.
Yeah, so Warren Wealth Management and Tax Planning, we are a fiduciary investment advisory retirement planning firm that helps people plan for retirement and then helps them navigate a lot of the issues and pitfalls that can come up during retirement. And then what we also do, in addition to that, where we think we add the most value, is we also do tax planning. We have a lot of IRS enrolled agents on staff. I'm an enrolled agent. Basically, that means that I know a lot about tax law, tax theory, tax code, licensed in all 50 states to help people save money in taxes and put more money in their pockets.
Yeah, I think a lot of times when people think tax planning, which you can help all across the board, I know we've talked about that before, but the tax deferred accounts like a 401k, they're like, oh, my account is this balance. No, it's tax deferred. You're going to have to pay for that on the backside.
Yes.
And it's important to think about those things, right? And you help with that.
Yeah, you have to. And when you think about it, you know, most people have their money saved in these tax deferred accounts, 401ks, IRAs, and it hasn't been taxed yet. And when it's taxed at whatever tax rates are at the time that you take those withdrawals. And one of the biggest expenses in retirement are taxes. And what people need to understand is this, is the fact that you can control what you can't control what you can't control. And what you can't control is the stock market, those investments. They're going to go up, they're going to go down. And when you have losses, you kind of hopefully keep your fingers crossed and you hope you have enough time to get that back. But what you can control taxes and how much you pay. Because once you lose money and pay money out in taxes to Uncle Sam, that money's gone. Right. At least what you make in the market, it can eventually hopefully come back. But what you pay out of your pocket, out of your wallet, out of your billfold, out of your purse to Uncle Sam, that's gone. And so if you can control that, you're going to be better long term.
No question. Speaking of stocks going up but stocks going down, we know that they're going to do that. We just don't know when.
Yeah.
The market volatility, if you look at the last several years, obviously with COVID and everything else, it's been a little bit all over the place. If you talk about cryptocurrency and all that, it's even crazier. Right. Talk about market volatility and really some of the things you look for and also why it requires patience.
Yeah, so, you know, market volatility, and we're seeing it a lot the last 6 weeks or so, where the market has had violent swings up, and of course, more importantly, and what really scares people is violent swings back down. And so when you're dealing with volatility, we tend to, keep investors focused on three specific things. The first thing is you need to do is you really just need to tune out the noise. There's so much information out there. There's 24-hour news stations, financial publications, social media, the Google machine, and really they are always focused on the short term. So they focus on the short term. Hey, this is what's going on now. This is what's going on this week. And really, when you're investing, you need to really focus on the long term. And this chart up here on the screen basically illustrates that if you can pump the brakes and have an idea of what is your asset allocation like, what's in stocks, what's in bonds, and you can basically kind of see that the average annual returns of those different portfolios. But what I really want to point people's attention to is those last two columns, because that's where the volatility goes in. So at the very top, you see 100% stocks, and you see that the best that it's done over a 20-year period is 38%, but the worst it's been down is 38%. Those are wild swings during that 20-year period. Versus if you move down to a 40% stock, 60% bonds, you see that that variance is a little tighter. It's not as you're not on that roller coaster ride. And I really think that that volatility, that variance, is what causes people to do the wrong thing at the wrong time, and they do it all the time. So if you can take a step back, pump the brakes, you'll be in a better position.
Well, I think just, again, going back to the start of COVID, March 2020, you know, when you see the market pull back, what was it, 40% roughly?
Yeah.
In, gosh, not long.
Yeah, 16 days, 30% in 16 days.
30 days. There were probably people, I'm sure, that left the market. And those people, if you followed the market in the last 20 months to follow, that was a mistake. Is that an example of, I mean, of course, that was a lot of noise, but is that an example of what you're talking about?
Yeah, that is an example because, you know, the media is going to focus on that fear and that greed. When things are going well and the stock market is at all-time highs, that's when it's going to bleed into mainstream media. And then conversely, when the market is down and the economy is suffering, it bleeds a lot of that information bleeds into mainstream media, and you hear about the fear. You know, but another thing that people can think about doing when there's market volatility is dollar cost averaging their way into the market. And so what is dollar cost averaging? And basically what it boils down to is dollar cost averaging is committing a fixed amount of money that you're going to put in at different intervals into the market, right? And so when the market's up, you'll be buying, of course, less shares. But more importantly, when the market is down, when people are generally fearful and they don't want to jump into the market, if you dollar cost average, you're actually doing what you're supposed to do, by the way, which is you're buying low and you're buying up more shares. And over time, you've kind of mitigated at least some of those bumps and those ups and those downs, and you can even out some of those share costs over the course of time.
So what's the best way to dollar cost average? Meaning, okay, so you identify an amount of money that you're comfortable with, whether it's a percentage of your paycheck, whether it's once a month, once a quarter, whatever the number is.
Yeah.
What about, do you pick a date, though, to dollar cost average? Do you do it on the you know what I'm saying? Because then the market could be down. It could be like, can you explain that a little bit more? How do you have that self-discipline to say, all right, it's time to buy even if it's low?
Now, generally speaking, I really, most people dollar cost average and they don't even know they're dollar cost averaging. So if anyone is participating in their company retirement plan, 401k, 403b, and they've said, hey, I'm going to put 5% away each year, or 15% away each year, each paycheck into my mutual funds, then you are in essence dollar cost averaging your way into the market. And what people understand is when you do it early and you do it often, you get your first job, you participate, over time it grows, and it grows significantly if you can just continue to do that, be disciplined, leave it alone, and then move forward. And
discipline is what it's all about, and that's what you guys do at Warren Wealth Management. If you could, Marcus, talk about the process. If somebody's watching right now and they're hearing the things you're saying and the philosophy that you represent, and they want to find out more information, like what's the best way to do that, and what's that initial phone call, for example, look like?
Yeah, and so you know, at Warren Wealth, we would love to work with everybody, but of course we can, and everybody's not really a good fit. And so what we've done is we have a website. You can go to talktomarcus.com. You can schedule that 15-minute phone call where we're able to find out a little bit more about you, where you are in your retirement journey, whether you're close to retirement or you're in retirement, the questions you have, and basically find out if we're a good fit. If we are, then we can move forward with a longer discussion. If not, we can just part ways, and hopefully you got something out of those 15 minutes.
No doubt about it. So one thing you're big into is getting your message out, getting not just your message, but the message of the market. You're on podcasts, you do this show, you do other things. Talk about why that's so important to you and to the community.
Yeah, I think it's just that. I think it is about the community. There's, you know, you have the retirement community, then you have communities that are underserved and don't get a lot of financial education. And so by putting different forms of media out there, whether it's the podcast, whether it's being on this show and educating listeners and viewers about retirement, about finances, about investment, it just helps.
And you can get that anywhere you get your podcast, right?
Anywhere you get your podcast.
That's right. WarrenWealth.net is the website, 502-339-8255. Marcus, thank you so much helping us navigate these volatile waters. Because let's face it, I'm not putting you on the spot for next year, but there's going to be more volatility in the year ahead, right? I mean, there is every year.
Absolutely.
There's no doubt about it.
No doubt.
So just make sure.
I can guarantee
it's going to go up and it's going to go down.
Absolutely.
You just don't know when. All right. It's about not timing the market. All right. Marcus Warren, thank you so much for being here today. We appreciate it. We've got more when we get back. Joining me will be attorney Jim Desmond.